You're making more money than you ever have, like genuinely more than you thought you'd be making at this point in your life. The raises came, the promotions happened, maybe you started a side thing that actually worked. And on paper, everything looks right. You're contributing to your 401k, you're not blowing money on stupid stuff, you've got a little saved up. You feel for the first time like you're actually getting ahead. And yet, there's this quiet, nagging feeling that the math doesn't add up, that somehow, despite earning more than ever, you're not actually building anything. The number in your account isn't growing the way it should be, and you don't know why. You've done the responsible things, you've read the articles, you've watched the videos, so what is happening? Here's the thing, the traps that steal your wealth, the ones that actually matter, they don't look like traps. They look like normal life. They look like good decisions. They feel like progress. And that's exactly what makes them so dangerous. Let me show you what I mean. The moment you start earning real money, and I mean real money, not just getting by, but actually having something left over, something shifts inside you. It's subtle, you don't notice it happening, but your brain starts to redefine what normal looks like. You got the raise, you moved into a slightly nicer apartment because honestly you deserved it after years of grinding. The car payment is a little higher, but it's still manageable. You eat out a little more because you're busy and you've earned the convenience. You upgraded your phone. You joined a gym that actually has good equipment. None of these things individually feel like mistakes. Each one feels completely justified. This is where it gets dangerous, because lifestyle creep doesn't announce itself. It doesn't come in all at once. It seeps in, one reasonable decision at a time. And here's the psychology behind it that nobody talks about. It's not really about the stuff. It's about identity. Every upgrade you make becomes part of who you are. The neighborhood you live in, the car you drive, the restaurants you go to, these things start to feel like you. And once something becomes part of your identity, cutting it feels like self-betrayal. You're not canceling a subscription. You're telling yourself you're not that person anymore. And that is a fight most people will not win. Studies have shown that Americans earning over $100,000 a year, people who should, by every reasonable measure, be saving aggressively, are still living paycheck to paycheck at alarming rates. Somewhere around 36% of six-figure earners have less than $1,000 in savings. Read that again. 6 figures, less than $1,000 saved. And it's not because they're irresponsible. It's because their lifestyle scaled almost perfectly with their income. Every increase got absorbed. Every raise got eaten alive by a slightly better version of the life they were already living. Now, you might be thinking, okay, but lifestyle inflation is obvious. I know about that. I've heard that one. But that's not even the worst part. Because lifestyle creep isn't just about money leaving your account. It's about the floor. Once you upgrade your life to a certain level, going back feels genuinely painful. You've raised your baseline, which means now you need this income just to feel normal. Which means you can't take risks, you can't leave the job you hate, you can't start the business, you can't ride out a bad stretch. You've built yourself a golden cage, and the more comfortable it gets, the harder it is to leave. And it gets worse the more money you make. But here's the shift that changes everything. The people who actually build wealth, not just earn well, but build something, they made a decision, consciously or not, to let their savings rates scale with their income before their lifestyle did. Not instead of living well, before. The raise hits, a meaningful chunk goes directly into building, and then the lifestyle adjusts to whatever's left. It sounds simple. Most things that matter do. Now here's where I want to shift, because there's something happening on a completely different level that most people don't see until it's too late. You've got a little money now, maybe $50,000, maybe $200,000. Maybe you're getting close to that first million, and you've got some of it invested. Good. But take a look at where it's invested. If you're like most people in this position, a disproportionate amount of it is sitting in one place. Your company's stock, a single property, one business, maybe even just cash because you haven't figured out what to do with it yet. And here's what you think is happening. You think you're being strategic, concentrated. You know this company. You understand this asset. You've watched it grow. Why would you diversify away from something that's working? Here's what's actually happening. You've developed an emotional attachment to that position that has nothing to do with investment logic. There's an ego component buried in here that's almost invisible. When that stock goes up, you feel smart. When someone asks about your portfolio and you can point to one thing that's crushed it, there's a pride in that. The concentration has become part of your investment identity. And that emotional ownership is going to make it incredibly hard for you to sell at the right time, rebalance at the right time, or even see the risk clearly. Enron employees had 60% of their retirement in Enron stock, not because they were stupid, because they believed in the company, because it had made them money, because it felt wrong to bet against the thing they gave their lives to. You know how that story ends. I'm not saying your position is Enron. I'm saying the psychology is identical. The simple but powerful shift: diversification isn't a lack of conviction. It's the acknowledgement that no single outcome should have the power to devastate you. That's not pessimism. That's how real wealth survives. But that's not even the worst part, because while this is happening, while your lifestyle is quietly creeping up and your portfolio is quietly concentrating, there is money leaving your life in a way that is almost completely invisible. No one talks about this one the way they should. I'm talking about tax inefficiency. Here's a scenario. Two people, same income, same investments, same returns. One of them is thoughtful about which accounts hold which assets, when they sell, how they harvest losses. The other one just wings it, doesn't really think about it, does everything in the same account, sells whenever, ignores the tax implications. Over 30 years, the difference in actual wealth, same income, same returns, just different tax behavior, can be hundreds of thousands of dollars, sometimes more. Taxes are the largest expense most high earners will ever face in their lifetime, larger than their house, larger than their car. And yet most people spend more time optimizing their Netflix subscription than their tax strategy. Why? Because tax pain is invisible and deferred. You don't feel it the day you make the decision, you feel it in April, and by then it's too late. And even then it feels abstract. It's just a number on a form. It doesn't feel like wealth being destroyed, but it is. The IRS doesn't send you a letter saying, hey, you left $40,000 on the table this year by not maxing your HSA, by not doing a backdoor Roth, by selling into wrong account. They just quietly take what you owe and move on. This is a wealth leak that runs silently in the background for years, decades, and most people won't realize what it cost them until they're looking backwards. Now, look, I want to pause here for a second because I can already feel some of you thinking, this is getting complicated, this is getting into sophisticated territory. And here's the irony. That feeling of complexity is itself a trap. Because here's what actually happens is people's net worths grow. They start adding complexity to their financial life not because complexity serves them, but because it feels sophisticated. They add more accounts, more strategies, more products, more advisors, more diversification layers. And at some point, and this moment is different for everyone, but it always comes, the complexity becomes the problem. They can't track it all. They can't optimize it all. Things slip through. Fees accumulate in places they're not watching. And the original, simple strategy that actually worked gets buried under layers of financial clutter. One of the wealthiest individual investors of all time famously said, most people would be better off owning a simple, low-cost index fund than trying to beat the market. And he said this having access to literally any investment vehicle on earth. The complexity isn't making you richer, it's making you feel richer. Those are very different things. But here's where I want to go next, because this one hits differently. Let's talk about time. Specifically, the moment when the relationship between your time and your money quietly inverts and you don't notice it happening. When you're starting out, trading time for money makes complete sense. You put in more hours, you get more pay. The math works. So you develop a habit of working harder as the default move. Problem gets harder? Work more. Want more money? Work more. This wires something into your brain. Work is the solution. Effort equals outcome. Now you've got some wealth, you've got some investments, you've got assets that compound whether you show up or not, but your brain hasn't updated the programming, so you're still working like your hourly output is your most valuable financial tool. You're working 60-hour weeks optimizing your job performance while your portfolio, which has the ability to grow without you, is sitting on autopilot getting modest attention at best. Here's the math that will genuinely disturb you if you let it sink in. $500,000 invested at 10% average annual returns generates $50,000 a year without you doing anything, without a single hour of your time. Every hour you spend grinding beyond what's necessary, beyond what's actually moving the needle, is an hour you could have spent thinking about the asset side of your life, the compounding side, the side that scales without your labor.
Now, I'm not saying stop working. I'm saying at some point, and you need to figure out when that point is for you, the most financially intelligent move is not more hours at the desk. It's more attention to what your money is doing while you're at the desk. Most people never make that shift. They just keep working harder as their primary wealth-building strategy long after it's stopped being the most effective one. And the opportunity cost of that, the compounding they missed, the decisions they didn't have time to make, that cost is invisible. Nobody shows you the wealth you didn't build. You only see what you have, not what you left on the table. And this is where most people lose everything. Not in one moment, in 1,000 missed ones. There's something else happening in the background here that I need to tell you about, and it's probably the most psychologically insidious trap on this list. Early success. Because here's what early success actually does to your brain, and I mean this in the most clinical sense. It makes you confuse luck with skill. You invested in something and it went up. You made a decision and it worked out. Maybe the market was favorable. Maybe the timing happened to be right. Maybe you genuinely were skilled, but your brain doesn't distinguish those things cleanly. It records, I made a decision, it worked, I am good at this. And then the overconfidence starts. You start taking bigger swings. You start dismissing risk more readily. You start believing your judgment is calibrated in a way that other people's isn't. And the really dangerous thing is that for a while, sometimes a long while, the market might confirm this. Not because you're especially skilled, but because in a bull run, almost everyone looks like a genius. There's a cognitive bias called the illusion of control. It's the feeling that your decisions are more responsible for your outcomes than external factors actually are. High earners are particularly susceptible to this because they're used to their decisions mattering at work. They're used to effort and skill producing results, so they apply that same mental model to investing, where randomness plays a much larger role than most people are comfortable admitting. Some of the worst financial decisions in history were made by smart, successful people who had recent wins and started believing they could see things others couldn't. I've watched friends go from healthy portfolios to devastating losses, not because they stopped paying attention, but because they started paying too much of the wrong kind of attention. They thought they were in control. They were navigating on ego. The most dangerous investment is when you understand just well enough to be confident, but not well enough to see the real risk. Now look, we're getting somewhere real here, because I want to talk about something that most finance content glosses over because it's not exciting. Debt. Specifically, the debt you already have that you haven't thought about in years. You took out that loan when you had fewer options. The interest rate felt normal at the time. Maybe it was the best you could get. But your credit profile is different now. Your income is different. Your financial position is genuinely different. And there's a non-trivial chance you're still paying yesterday's rate with today's resources. The psychology here is pure avoidance. Refinancing feels tedious. It requires paperwork and phone calls and time. And since the payment is already on autopilot and it's manageable, there's no urgent pain screaming at you to fix it. So you don't. You just keep paying. And here's what that costs. On a $400,000 mortgage, the difference between a 7% rate and a 5.5% rate is roughly $900 a month, $10,800 a year. Invested over 20 years at 8%, that's potentially over $500,000 in wealth you didn't build because the phone call felt annoying. Financial avoidance isn't laziness exactly. It's the brain protecting itself from a task that feels cognitively unpleasant, even when the financial reward is enormous. The pain of doing the work now feels more real than the distant reward of more money later. And so people with high incomes, people who understand compounding, people who know better, they let years go by at a rate they could have optimized out of existence. Now here's one that I saved for a reason, because this one is about time in a completely different way. Delaying investing. Not avoiding it forever, just waiting. Waiting until things are more settled. Waiting until you understand it better. Waiting until the market looks less scary. Waiting until you have more to invest. Waiting. And I want you to understand what waiting actually costs, not in abstract terms, in real ones. $10,000 invested at 30 years old becomes roughly $174,000 by age 65 at 8% annual growth. The same $10,000 invested at 40 years old becomes $100,000. You lost $74,000 in wealth not because you made a bad investment, but because you waited a decade to make a good one. That's the cost of time blindness. We feel time as something we have. Compounding treats time as a resource that gets spent whether you use it or not. Every month you wait isn't neutral, it has a cost. You're not standing still, you're falling behind, a future version of yourself who started earlier. And the tragic part is, the delay usually isn't about money. Most people who delay investing aren't waiting until they have enough money. They're waiting until they feel confident enough, until it feels right, until the fear is lower. And the fear doesn't go away on its own. The only thing that actually reduces investment anxiety is experience, which means the only cure for the thing that's stopping you is the thing you're avoiding. But there's one final thing I want to leave you with, because everything I've described, the lifestyle creep, the concentration, the tax leaks, the overconfidence, the avoidance, none of it kills you in one shot. And that's the point. That's what makes it so dangerous. There's no single catastrophic moment you can point to, no one decision that ruined everything. It's a slow accumulation of small, invisible, entirely reasonable feeling choices. The slightly nicer apartment, the tax form you didn't optimize, the refi you kept meaning to do, the month you didn't invest because things felt uncertain, the portfolio you didn't rebalance because it felt like selling something that was working. Wealth isn't usually lost in disasters, it's lost in the in-between, in the default decisions, in the path of least resistance, in the moments that didn't feel like moments at all. And here's the realization I want you to sit with. The version of you that builds real wealth, meaningful, generational, life-changing wealth, is not smarter than you. They don't have more discipline. They haven't figured out some secret the rest of the world doesn't know. They've just gotten really good at noticing the invisible, at seeing the trap before it springs, at making one slightly better decision in the moments that don't feel important. Because that's where it's actually happening. Not in the big moves, in the quiet ones. The question isn't whether these traps are real. You already know they are. The question is which ones are already running in your life right now, so quietly you haven't noticed yet.